I'm Marcy Trump. I'm the chair party for the CEADIR project, which stands for the Climate Economic Analysis for Development, Investment, and Resilience, CEADIR. And today we've got a very interesting panel of guest speakers who are going to be focusing on some new ways and also assessing some of the former ways of creating financing for sustainable land use activities around the world. Myself, as I said, I'm just a chief of party. I'll step up, step down. I just want to give you a little bit of instructions later when we have the Q&A. Those of all who will be coming up, you're going to have Leah, who's standing at the back of the room, helping you. But this speaker tends to be, you need to put it right here. So it may be within your really close space, but that's how it goes. And then also, what we'll be doing is holding questions until the end, in which we're going to have an open Q&A. Now, those of you who are on the webinar, there are a set of polling questions for you please to answer, and we will be going over those polling questions throughout. That tells us a bit about the audience who's here and going to be participating remotely, but it also gives us a bit of a flavor of some interest in why you're attending. I see several familiar faces, some other faces that are new to our series, and it is a monthly series put on. So let me just, can you click to the next slide? I'll just do the agenda. We're on the slide number 3 for those who are following on the webinar. But for those who don't know anything about the CEADIR project, let me give you a quick overview. The CEADIR is basically a new USAID project from the E3 Bureau, and it is funded by the Global Climate Change Office, as well as help to be managed through the Economic Policy Office, which is the E3 EP and the GCC offices. It's a 4-year, a little bit over 4-year, 4.5-year project going through September 2018. And we have the ability to work across all of these, I'd say, congressionally mandated pillars and U.S. government pillars in climate change, which means we work in clean energy, we work in sustainable landscapes, and we work in adaptation. So it's a bit of a unique project. It is global, but we work with countries. So we're very interested, and we're already setting up some activities right now that we will be with different missions. We also have a set of global support activities, which would be for helping USAID and governments. And one of the themes that we will be coming back to today, and you'll be hearing throughout our series, is we're going to be really taking a deeper dive into the economics and financing of how you do climate change actions. So today's, of course, landscapes, and we've really got an excellent stellar cast here, too. So I've got Dr. Eric Hyman here. He's an economist. He's one of our activity managers for CEADIR. I've got next to him is Bob O'Sullivan, and he has just put on a new hat as of yesterday. He's with Winrock International. He's done a lot of work on forestry and with the forest carbon markets program. I've got Dr. Gordon Smith at the end. He has also done a lot of work on RED and from the project developer standpoint as well as policy making, and not only done forestry but agriculture. And we've got J.P. Gibbons here, who is a really, really outstanding source of having worked with DCA, having worked with USAID, in really creating funds and financial instruments. So I think he'll really be able to set that platform and go into depth. These experts have a lot of depth. They may not be showing you all the depth they have today, but for those who are here, you can stay afterwards and talk with them. For those who are joining by the webinar, please send some of your questions ahead to us, and we'll have those questions asked. But wherever possible, bring up those issues. If you want to ask specific questions about funds or mechanisms, please feel free to do that. Okay, I'll turn it over now to Eric.
Thank you, Marcy. So as Marcy mentioned, sustainable landscapes is one of the 3 pillars of the USAID program in climate change. And it's focusing on trying to achieve lower greenhouse gas emissions and or high carbon sequestration, which is absorbing carbon through plant materials and trees, as well as achieving economic development. Agriculture, forestry activities that are productive for society. So we're also trying to coordinate this tightly with food and energy security as part of our climate change resilience policy. So as you can see, the baseline is increasing over time if in the absence of interventions. And so sequestration and mitigation is trying to reduce that level of carbon emissions below what would otherwise take place. So at USAID, we're focusing on sustainable landscapes and finance, trying to find solutions that help the poor and help forest-dependent communities. So it's not completely solely carbon mitigation, but it's a dual, multiple objective. We're trying to create the enabling and conditions for investment, both public investment and private sector investment, improve data and information for low emission development and land use planning. And we're working some with payment for ecosystem services, including REDD+. We'll be talking about, we'll explain that acronym in a few moments, to capture the value of high carbon ecosystems, and developing innovative incentives for the private sector to invest in low emission land use activities as part of their business. So REDD+ is part of the framework of the United Nations Framework Convention on Climate Change, UNFCCC, which contains guidance on key elements for developing national programs for reduction of emissions from forest deforestation and forest degradation, as well as from conservation programs. It also, to date, we have primarily focused on project level REDD+ activities, but there's an increasing trend toward what's called jurisdictional REDD+, where we're trying to work with a national or a subnational government for a whole program of REDD+ activities. And there are some opportunities for financing through the Forest Carbon Fund. There's also a Green Climate Fund that will be established soon. It's not yet operational. The U.S. government's contributing about a third of the funds for that, as well as bilateral pay for performance programs, and we'll be talking about some of these later in the presentation. There are also, in addition to the funds, there are carbon markets. There are compliance markets, which hasn't worked out quite as well, which are regulated, mandated cap and trade programs that were to involve the purchase of carbon credits. Hasn't worked out too well because largely the emission caps have been set too low. But there also been a small program of voluntary carbon markets. So some of you might choose to buy some carbon markets when you fly an airplane to offset the carbon that's emitted at that time. So in the UNFCCC, the role of markets was not well defined, but it's not excluded. USAID is supporting some pilot REDD+ activities, as well as improving the national REDD+ readiness. By that we mean the ability to plan and prepare strategies for REDD+ and capacity development activities. So REDD+, we view it as part of a comprehensive approach for incentives for national and international investment in land use that's low emission. So I'd like to turn it over now to Bob O'Sullivan. As mentioned, he's at Winrock International. He's worked extensively in climate change law and policy and REDD+. He co-led the development of the verified carbon standard for REDD+, and has worked with the World Bank and USAID's Forest Carbon Markets and Communities program. Bob?
Thanks, Eric. I'll sit down if that's okay. So this slide is essentially overviews. I'm on slide 10 for the people online. Overviews what I'll be talking about for the next 20 minutes. So this is the key message for what I'll be talking about. If you don't remember anything else, just kind of remember the main points from this slide. So as Eric was saying, REDD stands for reducing emissions from deforestation and degradation. That's the first REDD. And then the plus side of REDD refers to conservation of forests, sustainable management and enhancement of carbon stock. So that's the plus side of REDD+. When we talk about financing for REDD, there's a lot of different numbers that are put out there, and there's a lot of different ways of analyzing what's going to be needed to reduce deforestation and what it all might cost. And so you see there's some estimates of cost between $15 and $35 billion per year for reducing emissions from deforestation. So this is just the deforestation part, not talking about the other components of REDD+. And that's reducing deforestation in developing countries. And these estimates, they vary depending on what goes into the models, what goes into people's analysis. I think the $15 billion a year comes from the Stern Review. I can't recall offhand where I got the $35 billion a year from, but it's other peer-reviewed literature that's out there. And this assumes a mix of readiness, capacity building, and as well as also implementation of activities to actually reduce emissions from deforestation and conserve forests. And that's a lot of money, $15 to $35 billion a year. That's a lot of money to reduce deforestation. And the question that everybody asks is, well, where is this money going to be coming from? If you look at the UNFCCC negotiations, you'll see there's a reference to it's coming from a mix of different sources, public, private sources, including market and non-market. And there's been a lot of negotiations around what is meant by market, what's meant by non-market, how they work together, and those negotiations are still ongoing. But there is an understanding or an expectation amongst a number of different players out there that there will be some sort of a market mechanisms used to support REDD+. And a lot of people interpret that to be some sort of a carbon market. And so when REDD was getting going a number of years ago and references to markets were appearing, there was a lot of interest and excitement in REDD and REDD markets, and a lot of private investment was starting to flow into that area. But those markets have been slow to develop. There's a voluntary market, which is important, small, and growing at times. But there's the compliance markets, which haven't really developed at all for REDD. And I'll be getting into that in a little bit. So outside of the markets, there's a number of funds that have been set up to try and support REDD. This includes multilateral funds like the Forest Carbon Partnership Facility, which has got a readiness component as well as another component to actually pay for emission reductions. There's also a lot of bilateral initiatives. So Norway is doing a lot through their Norwegian International Climate and Forest Initiative, NICFI. The Germans are doing a lot through their REDD Early Movers program. Then USAID through various programs is also has also supported over the years a lot of efforts on the readiness side of REDD. And around $9 billion of public funding has been pledged to date, and around $6.5 billion of that is through various funds. But it's important to emphasize this is pledged as opposed to actually dispersed and spent to date. But you can even see just by looking at those numbers, 9 billion pledged versus a need of 15 billion at the low estimate. There's still a long way to go, and that 9 billion pledge runs over a number of years, not on an annualized basis, which is the $15 billion a year number. And so how are these gaps going to be filled in financing? Some people then point back to the carbon market and say, well, a carbon market is potentially a great engine for generating private investment into REDD. But I think there is still some uncertainty over whether that will actually happen, and I'll be getting into this quite a bit in the presentation, based on some analysis and research I was doing at FCMC before joining Winrock. And I think that we need to think beyond the carbon market, though, as to how we can work in developing countries to support sustainable landscapes, REDD activities in those countries. It's not based entirely on a transfer of funds from developed to developing countries. It's not entirely based on some reliance on an international carbon market, which may or may not eventuate, and even if it does, it's not going to be sufficient to generate the demand for emission reductions that's actually needed. There has been a lot of work done in a number of countries to date to try and move in that jurisdictional level, to develop jurisdictional programs to generate credits. And I think there is a real risk that if funds don't come to support these programs, that a lot of important political will in developing countries will start to evaporate. It's not simple for any developing country government to stick their neck out and say, okay, we're going to try this new RED thing. Nobody knows in that country what RED means. Going through explaining it, building that political will within the country, and actually going ahead and trying to do something on a state or province level is not insignificant. And a lot of this work has been done on a promise that, yes, there will be funding coming in the future. And if this promise isn't met, if stuff isn't done, I think my concern is 5 years, 10 years down the track, if and when there is larger amounts of money available, that political will be lost, and it'll be a lot harder to try and work with governments in developing countries to actually get them engaged again. So that is my elevator speech of what I'll be talking about for the next 5 minutes. So hopefully that sort of incentivizes you to listen and pay attention a bit. But if not, then that's the main message. So going on to talking a little bit about the carbon markets and where forestry has fit within these to date. So when we look at RED Plus, there's a whole different ways of carving up what fits within RED Plus. And you look at some of the different types of markets that are out there at the moment, and they have different eligibility rules around what can be admitted into that market, what's an eligible project category to generate credits. And you see there's a mixed bag out there. The clean development mechanism, which is the project-based mechanism established under the Kyoto Protocol to support projects in developing countries, that only allows afforestation and reforestation projects. If you have a project that's reducing emissions from deforestation or reducing degradation, that's technically not allowed within the CDM. It's not a recognized project type. There are certain ways around it, say with cook stoves, but I won't get into that. You turn to joint implementation, which is the project-based mechanism for projects in industrialized countries with a cap under the Kyoto Protocol. So this is the partner of the CDM, but for industrialized countries. There's different accounting for those countries, and there's a much broader acceptance of these different sorts of RED projects under the joint implementation scheme. But here with JI and with CDM, there's the question, well, you might theoretically be able to create credits through these different Kyoto mechanisms, but where's the market for those? So you turn to the European Union, which has been the main driver of the compliance market for a number of years, and there's no forestry credits allowed in those markets at all. So even though you have a theoretical market that can be created under these international mechanisms, unless there's real and meaningful and solid demand coming from compliance markets developed at the domestic level, everything just kind of falls over. And this is why there's been a lot of skepticism that compliance markets will work for RED. I think carbon markets and market mechanisms can work, but their greatest risk and their greatest challenge is it's a policy-driven market. It's an artificial market. An emission reduction isn't the same as a bushel of wheat. It's something that's created by regulation, created by policy, and if that policy isn't put together in the right way, the market just doesn't work. Turning over to the voluntary carbon market, this is where it's kind of anything goes within reason. And so there, all the different kinds of project types in RED are recognized. There's also work to expand that out to jurisdictional, so large state or province level efforts as well, also being recognized in the voluntary market. And so what's the implications of this? So what we did at FCMC, we've done it a couple of times now, is looking at, from a bottom-up approach, what sort of supply could be generated for RED credits looking forward, and also what sort of demand could come for these RED credits under a whole range of different scenarios. So what we did on the supply side is we surveyed essentially the voluntary market, as well as also some jurisdiction, so some state level initiatives that are out there, and looked at, well, what volume of credits could be generated from a combination of registered projects, as well as also projects and programs. So by programs, the state level stuff that's under development at the moment. So doing a broad survey around the world, well, what sort of volume could be produced from all these initiatives out there? We then compared that against what sort of demand there is out there. And so on the demand side, we broke that into 3 different scenarios of demand. We have what we call the status quo scenario of demand, and that's looking at the demand that's out there at the moment. So we can say, well, you've got the Forest Carbon Partnership Facility. Their carbon fund has got 280 odd million, or maybe 380 million now at the moment. So we know that's a quantified demand there. We have Red Early Movers program. There's a certain amount of demand that's out there at the moment. So we did a survey looking at the demand that's there now. And then we said, well, that's a snapshot of today. What about if new regulations come on board? So California has got a cap and trade market set up under the AB 32 regulations. In there's provisions for allowing red into that market, but the regulations to allow that haven't been promulgated yet. So in theory, there could be red developed in the Californian market, but it isn't actually there yet. So we looked around at scenarios of if there was some growth in a compliance market, what it would look like. And then finally, we looked at what we called our blue sky scenario. And this is, well, let's pull out all the stops on the demand. Let's assume that, so under the US, a couple of years ago, there was the Waxman-Markey legislation, which was going to set up a federal cap and trade system for the US. And that would have generated significant demand for red. Let's assume that would actually happen. Let's make a number of similar assumptions in other countries that would essentially represent the most demand that could come from developed countries. Then on the supply side, we also thought, well, let's look at some additional supply that could be out there, say, from Brazil, from some other large subnational programs that didn't have enough detail to make the cut of our basic supply model. And so we did all this analysis, and this is what we came up with. So in the status quo demand scenario against the basic supply scenario, and this isn't going to be surprising to anybody who's been following the market, there is significant oversupply. And we broke it up looking at program level supply and demand, and also project level supply and demand. And there's significant oversupply in the status quo scenario, not surprising to anybody. In the compliance growth scenario, against the current supply scenario, you can see that, well, on some assumptions, if you're assuming some growth in the compliance market or a fair amount of growth in the compliance market, that demand might actually exceed current supply of registered and projects and programs under a fair degree of development. And then in our blue sky demand scenario, this is where we pull all the stops out and say, okay, demand is going to be the biggest that it can be. And we compared that to the current supply of high quality registered projects and programs. You can see it's a lot bigger. But then when we add in our additional supply from Brazil and some other programs, all of a sudden, the market is again flooded. The caveat here is these Brazil numbers are based on the national emissions, which Brazil itself says are not compliance market credits, they're national emission reductions. But the important thing when we looked at these numbers a bit further is this was only a snapshot of stuff that's out there at the moment. It doesn't represent any potential growth in supply from other countries that are out there. And an important take-home that we got from this is that when we look at some other third-party analysis of what the potential supply is of red, and this is stuff done by Charlotta Streck and some others and published in Climate Policy, they come up with around 1.8 gigatons a year of potential, of feasible supply at under $20 a ton. Our maximum demand under the blue sky scenario will only capture 18% of that. So what that tells me is that markets can play an important role, but the most bullish, optimistic markets are only going to capture maybe 18% of potential feasible supply that's out there. And there is some uncertainty around these numbers, obviously. And this is an annualized basis, and it wasn't clear from the data that was out there, how many years it would take before that 18% ate into that supply, because that supply isn't going to last at that volume at that price forever. At some point, the supply is finite. It's going to shrink down. But the message there is we need to look at other policy options for supporting sustainable forestry, sustainable landscapes in developing countries that moves beyond an expectation that the carbon market will be the only solution. The carbon market, I think, will be an important part of the solution, but we need to expand out the thinking as how you can stimulate support for REDD and sustainable landscapes in developing countries. So there's another paper that we did in FCMC, which was looking at that very question. And we looked at a whole range of potential policy measures that could be done in developing countries to support REDD and other types of sustainable landscapes. And those first couple up there, so direct regulation, payments for results, the Norway type of model, market instruments, a carbon tax or a domestic emissions trading scheme, and they're all using some sort of modified environmental impact assessment as a way of supporting REDD in developing countries. And our conclusion from this is direct regulation, meaning basic laws in place to say, well, you need to stop land clearing, you need to control and have an understanding of what's going on in your landscape. That's the number one thing that needs to happen. But that's not a financing thing. That's a basic, governance. You need to control your landscape. And looking at what's worked in, say, Brazil for their reducing deforestation with some $1 billion incentive from Norway, compared to Indonesia, which had a similar incentive but couldn't generate emission reductions. That ability to control the forest landscape was our conclusion was probably the biggest determining as to why Brazil has successfully reduced emissions, whereas Indonesia hasn't with these similar $1 billion incentives. But the carbon tax and domestic trading schemes, in most cases, that's going to be much too complicated for developing countries to do. And our conclusion is maybe a couple of middle-income countries could do it, but most, that's not a viable option. The results-based payments also is not scalable, we felt. And the environmental impact assessment type of thing could be a useful way in some countries, but again, may not reach that scale. And so our conclusion was we still need to do some more thinking as to other types of domestic policies and measures and stuff that you could do. And this is where we come up with a laundry list of other things that need to be looked at. And I've been given the time's up, and so I will not dig into this in detail now, but simply flag that financial institutions play a role, both their lending policies, but also new types of financial instruments that could support sustainable landscapes, I think is an important part of that solution going forward. Thank you.
Thank you, Bob. Our next speaker is J.P. Gibbons. He's with the USAID Economic Growth, Education, and Environment Bureau and the Development Credit Authority. And he has structured over $250 million in guarantees, for loan guarantees in the environment sector.
Thanks, Eric. And just to give anyone who isn't aware of what the Development Credit Authority is, it's the loan guarantee platform for USAID. So we work very closely with the private sector in trying to mobilize capital for development objectives that USAID wants to support. Just to give you an idea of where I'm coming from in my background, frequently speaking with the private sector, financial institutions on ways to mobilize capital for development objectives, and specifically my area of expertise, environment, conservation, that whole area. And so this is a slide that I want to highlight for you. It's kind of where USAID is shifting. It's the new model for development, really, is how we're looking at it. And it's very much in support of aligning the private sector with the development objectives of USAID. So what we're trying to do is we're starting with traditional model for development, which was majority grants-based with some commercial financing coming in. And we're trying to shift in a sustainable way to a much larger pie of overall support for development. But that grants blue piece is actually the same size in each, but in order to get, because our budgets are not increasing for USAID, the development budgets are not exponentially growing. So in order to do that, we have to leverage our partnerships and relationships with the private sector to grow our overall impact. And so that's where we're trying to bring the commercial finance sector in. And how can you do that? Well, there's a number of ways. I'm sure many of you have heard about the impact investment community and what they're doing now. These are investors like financial institutions, but they're not only valuing their financial return, there's also some sort of social or environmental return that they're valuing as well. And so perhaps, not always, but perhaps they're taking a smaller percentage of return on the financing side for a equal or significant social return as well. Also with multinationals and corporates. So many more of them are in developing countries and consider those valuable markets. And so trying to partner, and we have at USAID, the new lab has a number of Pillar Partners, I believe they are, or I forget the name of them, but the Coca-Colas and Unilevers and companies like that are partners of ours, trying to leverage our relationship with them to increase development impact. So just an overall idea of where I'm coming from with this. This slide right here, so I'm on slide 21 for those that are listening, is from Credit Suisse's report, I believe it was in 2014, may have been late 2013, on financing conservation. And what they estimated, and the important part is that brown sliver for me, someone that works closely with the private sector. That's where they see, and this is all of conservation. So I know we'll be diving into sustainable landscape, sustainable land use, but just to give you an overall idea, because it's hard to get numbers specific in just that area. So they say that about 10.4 billion is currently spent in conservation investment. And this is the need. You can see the gap is the second one. Not sure if we might not have one of those, but the gap is the second piece right there, where it's 210 to 290 billion is what's really needed in order to hit our marks for where we need to be in terms of conservation and status quo for an environment. And so based on their estimates, you can see that we need to do significantly more in the overall conservation space. This, of course, includes, well, the big one, renewable energy, but then also sustainable fisheries, ecotourism, all your sustainable land use and forest conservation as well. So it's not specific to our area of study. And so here's another chart that might be able to demonstrate at least where the private sector is and how their investment in sustainable land use and forest conservation has grown. So this is the red plus carbon credit or offset market and how it's grown since 2005 through 2013 from Ecosystems Marketplace. Now this is an investment. There's a bit of a difference here, but again, it was a little bit difficult for me to actually pull total numbers of investment in sustainable land use. What this is the sale of carbon credits and the value placed on them. So I don't want anyone to read this into this is what's been invested in sustainable land use, but rather their returns from selling the credits that have materialized from the investment. But what I think is important here is to show the growth, that there has been significant growth and there has been private sector participation in these projects, in REDD+ projects that have produced carbon credits, and really has triggered a lot of my work in the space because financial institutions have realized, okay, maybe there is an opportunity to some degree, despite, well, not despite what Bob said, but Bob is definitely correct in what he said about where the markets are, but they do see opportunities based on the ability to sell some of these credits. And so now I'd like to go into a little bit about who is doing this and how they're doing it. So we have financial institutions, and when you think of financial institutions, most people think about your traditional bank, and that's really not who's in this space right now. And there's a number of reasons why. Banks have an ability to use capital in a certain way, and they're getting a lot of their capital from those that are putting their savings into the bank. And that's not the type of capital that they often need for this type of investment. So we're looking more at impact investors and investment funds and unique financial intermediaries that have more flexible capital, that maybe are getting their capital from philanthropic or funds that have a aim or purpose or initiative that says, I want to put my money in an environmentally friendly investment vehicle. They also have the need to have specialists for this type of investor. And there are funds out there that have people that have worked in this space for as long as Bob and Gordon have. And it's a different type of person than your banker that's looking at mortgages and some sort of other financial, like project finance projects. This is a unique type of investor, and they also need to be flexible. These institutions need to be able to reach out and travel and identify the projects where they are. And your traditional brick and mortar bank is not really the type of institution that is really looking to identify these types of projects. Their risk profile just doesn't match the type of investment needs. And then one other, so that's who we're looking at. We're looking at unique impact investment funds or other vehicles that are interested in investing in these types of sustainable land use projects. But then there's another type of financial institution that I want to bring up just because it's so large right now, and that's green bonds. I put a number there that's from the Climate Bonds Initiative, which is a nonprofit based out of the UK that tracks these things, and they have shown that the growth in green bonds since 2011, when it was a $1.2 billion market, to $36.6 billion by 2014, shows the exponential growth there. So that is an indicator of where things are going with green bonds, but now a lot of that is in the transport sector, the energy sector, and not as much, really very little. It's early days for sustainable landscapes. But what they're looking to do is try and grow that. They have a working group around that. Actually, through our CEADIR program, we're trying to look into the potential pipeline and enabling environment in some countries to try and wrap a green bond around some of these projects. So there's potential there. And then another piece that I want to touch upon is the change in focus of these funds. Bob talked about how there's a lot more supply than there is demand right now. And that has changed some of the investment strategy of some of these funds. Whereas previously, they used to think of, okay, I'm going to create a fund around REDD+ and sell the carbon credits as my revenue stream for the fund. Well, with more supply than demand, the prices aren't where they were 3-4 years ago, and they need to find alternatives revenue streams. So they're looking at ecotourism and sustainable agriculture within these projects that can produce revenue streams as well. Some of them are more heavily reliant on those revenue streams than the carbon credits at this point because they see them as more sustainable. Of course, it's on a project-by-project basis. There's also a lot of competition for the really good investments. There was an investment in Peru recently that had a number of these investors very interested in it. Now there's a large supply, so there's a number of investments that are really waiting for potential investors, and they're just not interested because they have a lot to pick from. But the really good ones, if you have a good business strategy and good financial projections, there's a lot of interest in partnering with you. And then many of them use a pay-for-performance model. This is where if a project needs $10 million, you're not going to get the entire amounts right away. You're going to likely get enough to sustain you for the next year and then track how you're doing before the next tranche of a loan would be paid and made for. Moving on now, I just want to go over some of the key tools to mobilizing these capital with funds. And risk mitigation is very important for the funds because they cannot just invest their money without trying to hit the risk profile that matches the return that they're going for. And these are very risky investments. So what they're looking for is some of the things that I have listed here, including guarantees. That's where my office operates. It's also, we closed a rather large guarantee with Althelia Climate Fund in the past year, which kind of highlights how guarantees can be used in this space. Loss reserve is another. This is where you might have, if a project needs $10 million, if someone can put up a reserve amount, maybe $1 million of that, so that if there is a loss, that $1 million is the first money loss and not the rest of the money, you're likely to get more investors into a project because their risk profile is lessened. There's also a number of different insurance pieces that could play here because projects are concerned about these issues. It could be weather, it could be political, it could be currency. So you might just want a specific insurance mechanism for one of those. Subordinated loans, that's where certain loans are repaid before other loans, and that more at-risk money allows the less at-risk money to flow in because it may not have flown in, or it may not have, that capital may not have come in otherwise. And then price floors, something that all financial institutions would love. This is where you could have an organization say, it could be public, it could be private. We'll put a floor at $5 for your carbon credits. And if you're able to sell them over $5, great, take that sale. However, if no one's interested in buying them for more than $5, we'll pay the $5 price. Don't see it very much. USAID hasn't done anything like that, but it's something, it's a security that the financial institutions would love. Just some partnership opportunities that they're also looking for. Co-investment, that's where they want to diversify their risk and not be the only ones in a project, maybe go with another public or private institution. Safe investment with proceeds at risk. I'll just highlight here, Althelia partnered with Credit Suisse in what was voted Environmental Finance Deal of the Year this year, where they actually got institutional investors to invest in the Althelia Fund by not putting their main capital at risk. Their main capital is in like a much safer green bond based in energy, but the returns is the at-risk capital. And you can read about it on environmental finance. It's a pretty unique structure. And then finally, linking to some of the supply chains through TFA 2020. Tropical Forest Alliance 2020 is the focus on sourcing certain commodities from non-deforested resources. They include soy, palm, wood and pulp products, and beef and cattle. And so if you can link through your RED project or through your Sustainable Landscapes project some of the buyers of these commodities, it would be diversifying your risk as well. Finally, I'm not going to go into what they do. These are a number of the major players in the space. Althelia Climate Fund, I mentioned based on our relationship with them. They have the largest global fund that's investing in this space at this time. You have NatureVest there. They're a subsidiary of the Nature Conservancy, also doing a lot in conservation. Down in Livelihoods is a French-based fund. They're on their second fund now, subsidiary of Danone, the yogurt company. And also some of the advisors. So they all have different business strategies, but they're all operating in this space. So it's interesting to see how one focuses on one area or the other. And then I'm running out of time, so I'll just very quickly highlight, we're continuing to see growth capital entering into this space. Nature Conservancy estimates that the amount of money from 2009 to 2013 has doubled. Jurisdictional programs, Bob touched on. The financial institutions would love to know how they can operate within the jurisdictional programs. And the last point I'd like to make is all these private sector financial institutions, they're trying to do what all financial institutions do, which is try and match their risk to their return. And they're trying to figure out any way to do so. So they're looking for more creative structuring and more ways in which they can mitigate their risk so that the returns that they're estimating from that can make financial sense. And with that, I think it's over to Gordon, or through Eric, over to Gordon.
Dr. Gordon Smith is one of the staff members in the CEADIR project. He has 21 years of experience in greenhouse gas emission mitigation for land use and has experience in forestry and agricultural land use management. Gordon?
Great. So I'm going to move. We've had a lot about the macro, big picture, what's the global market. I'm going to talk about some of the micro things from the perspective of somebody who's putting their money on the line and going to try to do something for the most part. And I'm going to try to relate those to this macro stuff. And so we talked about the demand for the outcomes. Carbon credits, you got to have a government program to create that demand. There's a lot of things like lumber and crops that people want those goods, so there's big demands for those, and we're looking at integrating them. Revenues greater than costs is kind of a no-brainer here, isn't it? But our challenge is our costs are often high and our revenues are low. We're looking for places where we can combine things in sweet spots. Now let's go into the substance, and I'll get back to this alternatives in a minute. Now, because we have a focus on development and poverty alleviation, we're looking at smallholders. And these folks are really hard to work with because there's a lot of them. You got to communicate with everybody. You got to have a structure for communicating. They're pretty risk averse, you know. They got to eat, and being short of food for an extra 3 months is kind of a problem. And very limited Very strong constraints on the financial front. So I will come back to how do we integrate with smallholders in a minute. But now here's the big picture. The concept, and ignore the numbers out here with the asterisks. That's how many countries were included in these studies. The big point here is that private domestic investment is the huge investment in agriculture. And this is people buying tractors, people building processing plants. And it is many times the size of public, especially international development assistance. So what we're going to be looking at is how do we steer this towards sustainable, low-emission development activities. So back to the developers. A key constraint here is if you're looking at financing, a lot of these financing deals are only a few years. You know, if you're running much more than 5 years, if you're not in the black in 5 years, most people with money aren't going to invest in you. Sometimes with forestry you can get, and sometimes certain sorts of capital investments, plants, you can get 10 years. Forestry on occasion longer, but short time horizons here for the people with the checkbooks. Risks, we might be able to get to that debt financing with banks if we can get the bankers to understand it and grasp it. But we're tending to look at high risk stuff here. We're not into the low risk debt financing and private equity, which is again a reason for shorter terms. You know, if you've got a private equity investor who's requiring 30% a year, you can't run too many years or you're out of money. Back to that, the revenues have to be bigger than the costs. Now we're also talking about a lot of ecological services that are unpriced. When we talk about sustainability, some of these things, they're hard to count, they're unpriced. To some extent, a farmer, they want to keep their soil productive, so they have an interest in maintaining the sustainability of their agricultural system. But carbon, currently, as Bob showed us, is largely an unpriced good. So we look at government support. But there's two possible areas where we've got a big lever here that we can use. Your social license to operate. You may have to meet certain behavior or performance requirements to be allowed to operate. Brazil is a unique case where the soybean business was very concentrated and happened to get their annual operating loans from a government bank. So the government could say, you don't get your operating loan unless you show that you're deforestation free. That's a big lever. You might not get your forestry concession unless you meet certain requirements. You may not get farming permits unless you meet certain environmental requirements. So we can have a social license to operate. The other big lever I see here is access to markets. Prime example is if IKEA wants to buy only Forest Stewardship Council certified wood, well, you may not get any more dollars per board foot or cubic meter of wood from IKEA than you would from somebody else, but that's a big buyer, and that's an incentive to meet environmental standards. Now, back to smallholders a bit. Transaction costs. If it takes time to talk to somebody, you want to talk to fewer people. You want to negotiate fewer deals. So there are some models out there. If anybody's interested, we can talk about systems and networks for interacting with smallholders. There are some options here, but it's easier to deal with a few a few landholders who have large land holdings. So that's why you see red projects that are headed that direction. JP touched on this idea of the more we can standardize the accounting, and this is not just financial accounting, but also carbon accounting and contracts and reporting, then it's cheaper and easier, and we can reduce our transaction costs. Another huge thing is delays. Think back to that time horizon. If you have several years of uncertainty if you're going to get your permits from the government to operate, or if you spend years negotiating who's going to get paid to do what, that can make your project financially unfeasible. And that's a huge risk. Now, a little bit on agriculture, and then I'll talk a bit about forestry. A big picture here is that most developing countries don't want to talk about emission reductions from agriculture. Their #1 goal is development and getting people fed. They'll talk about reducing emissions intensity, and if we want emissions reductions, we expect production to go up, then emissions intensity has to drop a lot before we get reduction in absolute emissions. So we're going to be having to find large reductions in emission intensity for agriculture. Now, on the plus side, we have those agricultural products that are valuable, so that gives us a potential for tapping into conventional private finance. We all know the risks from agriculture. So for forest management a bit here. That's agriculture, here's forest management. These are long-term projects. It takes a special investor to go into a project where you're not looking for your returns for more than a decade. We're also looking at probably stacking wood product revenues with any ecosystem payment, whether that's a carbon payment or other sort of payment. This also means that forestry policies matter. You want a government policy where you're going to put the transportation infrastructure for your agriculture away from the forest, so you don't give people an incentive to go into the forest to do more agriculture. And we might look at much of our revenue coming from traditional forest products and some from carbon credits, perhaps some from other ecosystem services, perhaps a bit from wildlife payments, ecotourism, things like this. A big issue in forestry is tenure and use rights. And if anybody's interested, we can go into that in the Q&A. Now, just to wrap up here, these are indicative returns. It's going to vary hugely by the productivity of your site. And for example, the soy numbers, the variation in there was year-to-year variation in the price of soybeans. If you are a price taker in a global market, price goes down that year, your profit may go to zero. Now, the fundamental concept in this slide is if you got household consumption that's not part of the market ignores this. $0, even though eating is very important to your survival. The other concept is that there's a bunch of low-value uses here. Pasture's a low-value use. Red credits is not going to outcompete a lot of other a lot of other uses. If you have a landowner who has options, they tend to go for a use with higher returns. Agriculture can be very high returns, often is very high returns. Forestry, depending on how you do it, is often very low returns. Extensive forestry, where you pluck out a tree here and there, is low returns. But if you can combine some sort of higher intense forestry in some locations with policies that maintain ecosystem functions that you want, whether it's water, wildlife, diversity. Diversity, you might need some lower impact. Maybe you can achieve your water objectives still with some more intensive use. There are some opportunities where you got substantial revenues from forest products. And so now that turns us back into what policies can get us the ecosystem functions that we want while allowing the operators to get higher returns. So I think there are substantial areas where forestry, we can do forestry, we can keep forests, we can have significant revenues. It doesn't shift to agriculture, but it takes policy thought and policy will. And so now we're going to, I'm going to hand it back to Eric, and I guess we're going to have...
Okay. First, I'd like to mention that we on 9/20 we had 33 people viewing the webinar. About a third of them were with government agencies, either in U.S. or abroad. A third of them were in the consulting world. About a fifth of them are with NGOs, and we had one Red Plus project developer online, and one person from a financial institution, no investors. We had roughly 35% of the people involved in forestry, a third involved in agriculture, 37% are involved in financing, and 32% in project design and development. 38% of the people on the web are involved in Red Plus activities, and the countries represented include Colombia, Jamaica, the US, Italy, Mexico, and Peru. So I'm going to start with a couple of questions for each of the panelists, and then we'll open it up more broadly. You can, we'll have a floating microphone available, and we'll also take some questions from the web. So first question is for Bob. You showed us the enormous size of the Norwegian pledges for the carbon markets. To what extent have these pledges been fulfilled to date?
Thanks. That's a good question. So Norway has made a number of pledges of significant amounts of funding for various countries, saying, well, if you reduce your emissions, we will pay for those emission reductions. In Norway, it's important to emphasize that they're not buying credits. And so it's not a carbon market transaction in the same way that we talk about in the voluntary carbon market or the type of stuff that JP was talking about with the Althelia deal. It's a different kind of thing. So in the case of their arrangement with Brazil, Brazil has been reducing their emissions. There is, some people have different opinions around whether the Norwegian pledge was the main driver of that or whether there are other factors in play, but they have been successful. So most of that money has been dispersed to Brazil through their Amazon fund. There's still a bit left to go, which will be generated this year and dispersed. In Brazil, it's important to emphasize that the amount of emission reductions generated far exceed the amount of emission reductions paid for by Norway. In Indonesia, as I mentioned, the case is the opposite. There's been a large pot of money on the table for a number of years, and no emission reductions generated or paid for by Norway. Similarly with Guyana, from memory, nothing has been paid for with Guyana. Maybe a little bit. I can't recall offhand. But I think it's important. I think what Norway is doing is great, but it does show that you can have this potential financing out there, but unless stuff is in place on the ground, it's not the complete picture. You can't just wave a big bag of money and magic happens. There's a lot of hard work that has to happen on the ground.
Okay. Another question for you. As you showed us the blue sky scenarios, could you talk a bit about the assumptions that are going into that scenario and how likely that is, how optimistic it is?
The likelihood is easy to talk on. It's entirely speculative. My own view is that's not going to happen anytime soon. Some of the assumptions into that were to look at what's the maximum theoretical demand that could be out there from domestic sources. And so, we assume that somehow maybe under the next administration in the US, something similar to Waxman-Markey will be passed. We saw it was very hard to get it. Where it happened a couple of years ago, that's a big assumption. That would be great if it happened, but I won't speculate onto how likely that is. I'm sure other people in the room have informed views on that as well. But we made similar assumptions for other countries. So we assumed there would be demand from a number of developing countries. We assumed there'd be significant demand from places like Australia, where I'm from, if people have been following Australia, they know that there was a national tax that was going to turn into a cap and trade that was passed by a left-leaning government. The right-leaning government came in and promptly unwound it all. So for that assumption to happen, there would need to be another change of government and another set of federal legislation put in place again. So the exercise wasn't so much to predict what the demand would be, but just go through that thought experiment of what's the most feasible domestic demand out there. Because I think something that's important is that you can have an international agreement in place. We saw with the Kyoto Protocol, that created this theoretical international demand under the Kyoto Protocol. And there's talk that if a similar type of demand is created under the UNFCCC in some sort of a new agreement, that would be fantastic. But it needs to be translated down to domestic sources of demand. And so that was kind of the playing around as to, if you did have something, what would it translate down to? And so it's not likely, I don't think, unfortunately.
Okay, and then did the European Union specify a reason why it would not allow sustainable landscape projects in its compliance market?
There were a number of different reasons have been given. I think one of the reasons that they have put forward is that they were focusing on energy and reducing emissions from their energy sector, and they didn't want to have forestry brought into that. That's one of their arguments that they had put forward. Another is there was essentially within the Commission, within the European Commission, as well as other areas within Europe, a skepticism of the credibility of forestry credits. And so that was another area where there was some opposition within civil society within Europe and within some European governments to CDM red credits, CDM afforestation, reforestation credits being brought in. The accounting for those CDM credits is also a bit funky. They have these temporary credits, and that was another argument that was put forward as, it's too hard in our registry to do it, which I have my own views and others as well. But that was kind of their main argument. And they will, on the other hand, will be supporting red and other forestry stuff through auction proceeds. So some of the allowances that are auctioned in the European scheme, some of the proceeds for that then gets rechanneled back into supporting forestry. So they do use their emissions trading scheme to support forestry, but indirectly as opposed to directly allowing into their scheme.
Okay, and this question is either for you or for Gordon. If you could address what empirical evidence there is that if you do a REDD+ project in one area, that it's not leading to greater deforestation in another area.
Yeah, I can do it, but
As the one who wrote the VCS leakage module for jurisdictional REDD, I'm going to give two answers for this, and it's partly a matter of scale of which answer is applicable. You can look at the very large scale, you can look at price elasticity of supply, which means as price changes, how much does supply change, and price elasticity of demand, as price changes, how much does demand change. And if you had big changes in supply, if, for example, there really was agriculture going to go into this forest and you prevent it, you've constrained supply, you've taken supply off the market, half, 2/3 would be displaced. If you're looking at somebody eating, people are highly motivated to eat. Do they have an option to go do some low emission way to eat? Maybe yes, maybe no. So in the absence of account of policies that maintain the supply of the good that otherwise would have been displaced, you would have significant leakage. For a very small project, there's flux in the system. The economic theory would say 100% leakage, but in practice it might be 0 because it's just rounding error in the system. If a lot of these accounting systems, one country is not responsible for the emissions of another country, much of that displacement, let's say you assume that half is displaced, most of it's going to be displaced to another country. So as a result, in our leakage accounting, very small amounts tend to get attributed to the country where the activity occurs. And the only country with significant in-country leakage is Brazil. And I think that's a long enough answer for that.
All right. JP, in the carbon credit sales graph that you showed us, was that showing the amounts actually paid to date, or that's a series of multi-year future commitments?
So that was from the Ecosystem Marketplace, which does a lot of great data analysis of the voluntary market. And that was what was sold that year. So it had multiple years. And so they poll both project developers and financial institutions and credit brokers to identify as best they can from polling the market how many credits and at what prices were sold that year. So that was a cumulative of all the credits sold for that year. And then they also break it down per credit, which is why the financial institutions have been concerned, because the trend has been that the price per credit has been decreasing over the past couple of years.
Okay. And I mentioned, this is more of a comment than a question, you'd mentioned the Tropical Forest Alliance 2020.
Yeah.
This is a U.S. government initiative to work with major, particularly multinational companies to get them to make voluntary pledges to have no net deforestation by the year 2020 in those 4 sectors that you mentioned: soy, beef, palm oil, and wood products.
Yeah, and I think, thank you for bringing that back up. I didn't get to fully explain that. But also, the Consumer Goods Forum is signed on as a partner for the TFA 2020, along with a number of governments. And it's still, everything is still being worked out with it. But the hope is that these companies will make good on their commitments to source these commodities from non-deforested sources, and therefore the ability to partner with projects and financial institutions in creating some sort of mechanism where the financing can get down to the project developers or the smallholder farmers to alter their methods to produce this agriculture in non-deforested ways that then has the support of these large multinationals to buy these commodities from them. And so it would be a multi partnership of many different actors, multi-actor partnership that I could foresee happening as the TFA 2020 gets further developed.
Okay. JP, Bob had mentioned that he didn't think that results-based payments were scalable. Is that something that you agree with?
So I'm not as versed in, like, at the country level and at the multilateral funds level, where Bob or Eric here would be better to speak about it. But what the financial institutions are very concerned about is putting too much of their capital at risk early on. So why they do it is because if they want to see incremental improvements in their projects before making another type of payment. And so it's a sound method to use at the micro level that I work at in individual transactions. It could very well be that at a larger country level, the scaling just isn't there.
Okay. Bob, why do you think it's not scalable?
Yeah, thanks for bringing that up. I think I should probably explain a bit more about my comment that results-based payments isn't scalable. We were looking at a fairly narrow model or definition of what we define results-based payments to be, and this was looking at that Norway type of model where it was a direct payment from a government, say, to another government. There could also be a direct payment, some maybe domestic funding as well. And here I think it's a good model. I think some sort of performance payment or payments for results is an important part of RED. So carbon markets is also an example of results-based payments. A whole range of things could fall into that category of results-based payments. And I think that broad concept of paying for results or paying for performance is scalable and can work at scale if you can find the funding sources. But I was referring to the more narrow definition that we use for our paper of that more of that bilateral relationship type of thing, say between Norway and Brazil or Norway and another country, simply because there is only one Norway and there's only one Germany, and the amount of money they have on hand from public sources is not enough to pay for the overall results.
Yes. Question from the web?
Yeah, we actually have, I think, 3 questions online.
I think those domestic subsidies, and I kind of flagged that in the laundry list of things we need to look at in my last slide. I think that's a very important piece of the puzzle to look at, because I'm not familiar with that paper, but I have seen similar numbers elsewhere that you're trying to have some sort of a RED project, and you have a drop in the bucket of funding, and that has to go up against agricultural policy subsidies that completely overwhelm that amount of RED funding. And so I agree that that's one area that there needs to be more work done and to look at and to try and change those subsidies, those policies, so that instead of incentivizing land clearing, they're rejiggied so they incentivize a more sustainable production of agricultural commodities. So yeah, I would that doesn't surprise me, and I would agree with that.
Yes, that's a very important issue. And actually looking at subsidies in the energy sector, the IMF did a study that found that we could reduce carbon emissions by 13% if we just eliminated the subsidies for largely for petroleum production and use. Okay. Yes?
We have a question from the audience.
Thanks very much. My name is Chris Payne from USAID. Thanks very much for the presentation. I think one thing that comes out very clearly is that this can be quite expensive. I'm reminded of a chart that I saw in The Economist some months ago that tried to do unit costs of various carbon reductions. And in terms of being very cheap, they pointed, I think, to the Montreal Protocol, as well as what Norway was doing, Brazil. And at the very bottom of the list, if I recall correctly, was what Germany was spending on energy efficiency. That is, it was orders of magnitude more expensive to do that. Do we have a radical misallocation of funds here? You want to know where the money comes from, have Germany stop wasting billions and billions of dollars.
I'm not exactly, well, all right, to try to respond to that. I think what Bob just said is the direction that I think is fruitful to look at. And that is, look at where our policies encourage emissions. Like, for example, is a fertilizer subsidy resulting in fertilizer being used in places or in ways that result in inefficient use that's higher emission and less of the fertilizer going to crops? In many countries, that's not going to be a problem. In the US, we don't have fertilizer subsidies so much, but we do have some overuse that results in extra emissions. Is there a way we could change that program or change that policy or have a different way of supporting the development goal that is more resilient over the long term and lower emission? So perhaps instead of having a fertilizer subsidy, you have support tech transfer and demonstration projects on how to do no-till agriculture and keep your residue and improve your soil quality. You know, this is where it gets specific and down in the nuts and bolts and hard to implement. And of course, it's extremely hard to take away a subsidy that already exists because you've got a constituency who wants that support. But I think there are directions to go, and what we really need to be looking at is, for each country, what are the policies that government could adopt that would move its economy in this lower emissions sustainable direction?
Another example there, rice production, paddy rice is a major source of methane emissions, which is a very long-lived greenhouse gas. And there are technologies such as urea deep placement of fertilizer, which reduces the methane emissions and increases productivity and can reduce costs in certain instances as well.
Line for JP.
JP, Lauren Cooper asks, you mentioned there are a lot of competition for quality projects. How are investors connecting with such projects? How are they shopping around? And are they warehoused somewhere?
Sure. So this, as far as investors finding out about projects, the community is pretty small. I didn't list all of the financial institutions investing in this space, but I listed a number of them. So it's not like a lot of the other financial markets where you have a wide array of financial parties playing. So I've introduced a few, but I'd say for the most part, financial institutions are well aware of projects that are out there that are the really good projects. Now, Lauren might be working on a project that is seeking to reach these financial institutions, and I see that much more, where projects that need financial support are really trying to get in touch with these intermediaries. And the best way would be to call them up and to see if, to submit your slide deck and see if they have interest. And they may or may not have interest because each financial institution is focused in different things. As I mentioned before, some are very much focused on just establishing red credits and trying to get the most maximum production of credits out there. Others are very much focused on, well, what other sustainable livelihood activities do you have in addition to the red credits? Because I want to diversify my revenue streams and I don't want it focused solely on red credits. So you should have multiple sources of potential revenue coming in, or we're not really as interested in the product. As far as, I think the second part of that question was, how are they fighting over these projects, or when there are really good projects, what's happening? Well, it's kind of like I would equate it to this, if you're looking for a mortgage, you're probably not going to just go to one bank and say, what rate can I get here, and say, okay, I'll sign up with you. You're probably going to ask a few different banks, you know, what rate will you give me, and what are the terms of the mortgage. And so a term sheet will be produced, which is 1 or 2 pages of the basic terms without getting too heavy into the legal aspects of it yet. And you can weigh a couple of options based on those term sheets. They're not going to be as standard, although Gordon mentioned standardization, as mortgages, but still you can get a sense for what the multiple financial institutions are looking at. And I've seen that happen. And then the project developer has the opportunity to choose which one is the best fit for them.
JP, is there a
Yes.
central clearinghouse where someone can go for that kind of information, or is it a lot of transaction costs to do that search?
Yeah, unfortunately, there isn't that I'm aware of at this time. But one, as far as projects that are online and that are getting close to produce credits, there are the registries that they will be located on. So you have the VCS, which was mentioned, and so a financial institution could see what projects are registered there if they haven't received financing yet, and identify them that way. As far as identifying the financial institutions, Google search is pretty good. There are conferences and things like that for the conservation finance community that most of them will be attending. The Carbon Expo, for one, most of them will be in Barcelona this year at the end of May.
Another question from the web?
Yes, this next question is for Gordon from Santiago Enriquez. Are there standards in the voluntary market that generally result in higher revenues and lower costs? How much does MRV influence the financial feasibility of REDD+ projects?
Okay, so two questions. Are there standards that influence the costs? At the risk of sounding flippant, if you have a very weak standard that allows you to get a non-additional credit through, then you have a very low-cost credit. So from a public perspective, we do want standards that when the demand is low relative to the supply will still be getting us additional and high quality credits. But I don't think that's quite what you were asking. Maybe you were asking a little bit more of, are there particular standards that are more or less expensive than the others? The standards are starting to become more similar to each other. For different kinds of projects, now to transition to the second question about monitoring and verification, if all you have to do is put a meter on something and have somebody check the meter, that's a lot easier than doing the social CCB kinds of social monitoring to see if if local people are being treated well and are engaged and are benefiting from the project. For measuring trees, it's kind of a matter of scale. Measuring 100,000 hectares might only cost you half again as much as measuring 10,000 hectares. So forestry projects are, the monitoring is the marginal cost of monitoring a larger hectares is very small. So it's very much cost effective to do large projects. But again, if you have to deal with a lot of different actors, a lot of different people who use the land, that makes it very complex and raises your costs. So that's not a very clean answer, but better than it depends.
Just to add to that, I guess to throw out some names and numbers of different standards. A couple of years ago, I read a study that looked at the return of, say, adding the CCB that Gordon mentioned. That's a community climate and biodiversity standard, which isn't a quantification standard. It assesses a softer social side and other environmental benefits. And adding that onto a carbon quantification standard like the VCS was seen to give an extra $1 or $2 bump in terms of value of those carbon credits. But that was a couple of years ago. But now it's more moving towards where you need to have CCB just to be in the market, because there is more competition, and so there is that move towards, well, a limited number of financiers, buyers want to have the best products that they can buy, and so that CCB, VCS, or CCB and something else is kind of seen as a market entry requirement by a lot of people at the moment. And that price premium is more or less evaporated from what I hear.
Hi, Eric Cox-Dowson with USAID. I have a question for Gordon Smith. You had a graph in your presentation that showed the sources of finance for agriculture, and I believe it was for smallholder agriculture. And so I was kind of curious in that domain whether that domain is in a sense capital constrained. So if a new source of finance were to come in that was seeking to promote greenhouse gas emissions reduction, would that be in effect crowding out existing sources of finance, or would it be would it be sort of new? Or to put the question differently, is the reason that there's not more emission reduction in that sector, is that a consequence of lack of finance, or is it something else?
Yeah, great question. About crowding out is the part I'll focus on. That chart was not smallholder necessarily. It was smaller and medium-sized countries, and it was largely commercial agriculture. The genuine smallholder, these are people who are farming 1/2 hectare to 3 hectares, and they range from people who have essentially zero capital. You know, $15 to buy seeds is a major purchase, and some of the things you start out with are social groups of a small number of farmers who know each other and they'll save, or an NGO that gives them access to seeds so they can have higher yielding seeds. And then maybe next year they can join together to get a harvesting implement or something else. Yes, they are extremely capital constrained. I think at the smallholder level, we have no worry about crowding out. It's how do you reach those folks? How do you work with them to make sure there'll be a payoff, and who's going to loan to them? A lot of the microfinance is designed for businesses where you buy a good and at something closer to a wholesale price, and then you retail it and you can pay it back in days to weeks and at most a couple of months. And a lot of the microfinance is at rates that are, they may be 30% a month, and you can't wait 4 or 5 months for a return from your upfront initial investment in a seasonal crop from revenue from selling your extra at the end. So I don't think there's any worry of crowding out when it comes to smallholders.
What if you go up the scale?
I would argue that if a firm has adequate access to capital, then we don't need to worry about crowding out. They're doing fine. We're worried about steering their activities into a sustainable direction, and if they don't need capital that is somehow publicly supported, that's great.
Okay, we're at the end of our time. I'd just like to mention that we do have another seminar in our monthly series. The next is coming up on May 12th, and it's on the assessment of co-benefits and how that affects financing. And by co-benefits, we're referring to the environmental and social and health benefits that can be associated with climate change mitigation activities. So we hope you'll be able to join us then. Thank you.